Saturday morning to everybody out there. Welcome again to another edition of the Wealth Guardians radio program where we tell you what you need to hear, not necessarily what you want to hear. I got Bryce and JB. The gang's all back here with me again today. Hey, guys, what's going on?
Good morning.
Good morning, Carolina.
Hey, good morning. Again, before we start the show, let me give a big thank you to all of our service members and first responders out there. Thank you for everything you do for us. So again, welcome into the Wealth Guardians radio show. You can find us at www.thewealthguardians.com or just give us a call for a chat at 336-391-3409.
Well, once again, good morning, everyone, and welcome to the show today. You know, every year there are rule, guideline, and tax law changes to deal with when it comes to saving for and managing your retirement plan. And this year is obviously no exception with a new tax code in place. People everywhere are wondering just how they can adapt to the changes and maximize their retirement accounts. Well, that is exactly what we're going to be talking about and discussing with you today.
Yeah, JB, that's right. You know, we've had a big tax law change, and that's why I chose to write the show today about a lot of these topics, because we got to stay on top of them. And like you said, with new historic tax codes in place, this year's obviously not an exception. So you have to keep on top of things in order to maximize your retirement. So in order to do this, the most proper way, most people will need some sort of professional guidance. Things change quickly and often. So, for example, just a couple weeks ago, the Treasury Department announced that it was ending the MyRA program. The MyRA program was put in place a few years ago to help Americans with no access to employer plans to save for retirement. It had a low minimum contribution, a guaranteed return on savings, and was also guaranteed by the U.S. government to never lose an individual savings.
Well, you know, Doug, that sounds like a very good savings plan. Why would it be taken away?
Well, you know, unfortunately, many people who qualified for the MyRA program were just not taking advantage of it. The Treasury Department decided to get rid of the plan and focus on some of the other plans that are more commonly used. So if you didn't know about the change, then it could hurt your plan as you need to adjust and adapt and make some changes. Fortunately, there's still several ways to save and maximize your retirement plan. But in order to get most out of any type of retirement savings plan and maximize your accounts, you have to know about and understand the updated rules as well as several other key factors. The first key factor is where to contribute. So in other words, what specific type or types of plans are the most proper to use for your unique and specific situation? This may very well have changed this year based on the new codes, the tax codes, and we'll discuss these details today. The second factor is understanding the tax issues on each type of plan. The goal is to maximize your contribution the most tax-efficient way possible. And this can make a huge difference in the ultimate value of your account. Again, very important to understand with the new tax code. The third factor is understanding costs and fees. Contributing to retirement accounts is not free. However, there are some strategies to minimize the effects of fees and expenses. And finally, the fourth factor is to invest smartly. The investment world today is much different than it used to be. You know, buy and hold strategy and target date funds may work for young people. Those people in their pre-retirement and retirement years need more of an adaptive approach that adjusts to changing market environments, especially with markets at all-time highs and way overdue for a major correction. So we're going to discuss these factors in more detail today, as well as answer some retirement savings questions for you in hopes of helping you figure out the best way to maximize your retirement account. So, JB, let's get started.
Okay. Well, you know, since the defined benefit pension plan is no longer a part of many people's retirement plans today, personal retirement accounts like 401ks and IRAs are now the main type of accounts that most people use. So why don't we just start up with those plans?
Yeah, you got it, JB. You know, because most companies don't offer a pension plan anymore, because of that, most personal retirement plans, such as your typical 401ks, 403bs, and IRA accounts, they're the most popular and commonly used tools for saving for retirement today. But just because these plans are popular, it does not make them automatically successful. You still have to understand them and do the right thing with them. You have to know which plans to use, how to use them properly, and follow the IRS rules and guidelines for each one in order to get the most out of them.
That's exactly right, Bryce. And as you said, in order to maximize your personal retirement accounts, you have to go a lot further than just contribute. The goal needs to be to maximize your contributions, if at all possible. Unfortunately, it appears this is not being done. Now, in a recent 2013 survey, the American Benefits Institute reported that while employee participation in 401k plans is very high, fewer than 10% of the employees enrolled elected to contribute the maximum amount. Now, what is even worse is that it's estimated that more than half of the employees are not even contributing enough to their 401k plans to qualify for their company's full employer match. So that is definitely a problem. And if you're going to maximize your retirement account, this definitely has to be addressed and it has to be fixed.
No doubt about it, JB. It does have to be fixed. So to maximize your personal retirement accounts, you want to contribute the maximum amount you're allowed to by law. Remember, different plans have different contribution limits. For this year, the contribution limits for company-sponsored retirement plans have been increased. That's good news. And for those who want to be able to save more for retirement income, that's great news. The maximum amount you can contribute to a 401k and a 403b plan in 2018 is $18,500 if you're under 50. Now, if you're over 50, it goes up. You can contribute up to $24,500. Now, for IRAs and Roth IRAs, the maximum amount you can contribute is $5,500 if you're under 50, and if you're over 50, you can go as high as $6,500. Now, simple IRA plans are $12,500 for those under 50 and $15,500 for those aged 50 and above. And SEP IRA contribution limits are up to 25% of compensation subject to a limit of $55,000. Now, if you can't contribute the maximum, at least contribute as much as you have in order to get the company match. That's free money. I don't know too many people who would turn down free money. Do you, JB?
No, I do not.
Not either.
And I can't think of any reason why you would not want to take advantage of free money.
Well, there sure aren't many, that's for sure. You know, JB, I would tell everyone to check with your benefits manager to get up to speed on your employer's matching offers and set up automatic deductions from your paycheck to make sure you take advantage of the employer match. I mean, again, that's free money that you don't want to leave behind. Now, these are not the only types of retirement savings plans available. There's a number of others, and actually you may very well be able to contribute to more than one type of plan at a time if you qualify. And that, of course, is going to help you maximize your retirement plan. In fact, most people are able to contribute to both a company-sponsored retirement savings plan and a personal plan on top of that, like, say, your traditional Roth IRAs. But so many people just don't realize you can do it. So again, my advice is to work with a professional retirement planner to help you figure out the most advantageous way for you to save to maximize your retirement plan.
Now, in order to maximize your personal retirement accounts, don't you have to make sure you completely understand the tax issues of the different types of accounts?
You certainly do, and we need to talk about this. Again, we have a new tax code in place this year, and with it being such a major tax law change, it could very well affect the types of accounts you should be using to save for retirement. As we said, you want to do everything you can to maximize your contributions, but you want to do this in the most tax-efficient way. Each plan has its own specific tax laws and rules, so you have to understand how each plan specifically works and under what circumstances you should utilize the right and most proper plan for your specific situation. Understanding what type of account to contribute to and how to contribute in the most tax-efficient way can make a huge difference in the ultimate value of your account. For example, a traditional IRA, 401k, 403b are pre-tax contribution plans. The money you personally contribute comes out of your salary or is deducted from your W-2. You only pay tax on the net amount, which lowers your tax bill for the year that you contribute. In other words, you're not paying tax on the money that you contribute to the plan. This money will then grow over time, and you'll pay taxes on the money when you withdraw it from the account. Now, the Roth 401k and 403b are different. They are basically just the opposite. These plans you contribute after tax dollars. In other words, the money you contribute does not come off your tax return in the year you contribute. You're paying taxes on the dollars that you put in. However, the gain on those dollars later grows tax-free and comes out of the account tax-free when you withdraw it. So as you can imagine, that can make a huge difference in the ultimate value of your retirement nest egg when you retire.
So, guys, which type of plan should you choose? I mean, which one is better?
Well, JB, whether you should contribute to the traditional side with a pre-tax contribution and take the tax deduction today, or to the Roth side where it's an after-tax contribution, that all depends on each person's unique and personal situation. The key, obviously, is choosing the right type of plan that's best for you. And here's what to consider. If you're in a high tax bracket now and you expect to be in a lower tax bracket at retirement time, then you probably choose the pre-tax way of contributing. This way you get a tax break on the money now at your higher rate, and then you'll pay tax on those dollars at hopefully a lower rate when you retire. That's the ideal situation for contributing to the traditional pre-tax plans. I mean, everyone wants to pay the least amount in taxes. I know you do, JB.
Right.
So in this situation, you're proactively contributing in a way to hopefully minimize your tax consequences. Again, it's just common sense.
And so to make sure that you're actually doing everything you possibly can to maximize your retirement accounts, I would invite you to come in and just sit down with Bryce and I, and let's just talk about your situation. So it's free. There's no obligation. Call us at 336-391-3409, and let's make sure that you're contributing in the most tax-efficient way and the best way for your situation.
And a quick reminder, you are listening to the Wealth Guardians radio show, heard locally here on 94.5 WPTI. We really appreciate you being with us. We can be reached at 336-391-3409 or visit the website at thewealthguardians.com. Now, we're up against a quick break, but when we come back, we're going to be discussing the two other factors regarding how to maximize your retirement accounts, as well as giving you the answers to some very good retirement savings questions. Stay with us. We'll be right back.
With you, and if all my dreams come true.
And welcome back to the Wealth Guardians radio show, where we tell you what you need to hear, not what you want to hear. Right in the middle of our show about how to maximize your retirement in today's financial world. You know, before the break, Bryce, we were talking about pre-tax contributions in an IRA. Well, what about the reverse position? I mean, Bryce, let's say you're not in a high tax bracket now, or maybe you fear taxes that are going to be much higher in the future.
Okay, JB. Well, in that scenario, you probably want to contribute to the Roth side then.
Okay.
And that there is actually the more likely scenario now with this new tax code in place. And I tell you, this new tax code is near historic lows, JB. Mm-hmm. Tax rates for many people have never been lower, and in all probability, they never will be lower. So now could be that absolute prime opportunity for those people to contribute to the after-tax Roth option. So let's do an example.
Okay.
Let's say that your joint income from all sources of income for you and your spouse is $100,000 per year. Well, even if you just take the standard deduction, your taxable income is going to be in the 12% tax bracket. That's amazing, but it will be. And in all probability, that is the lowest tax bracket that you will ever see, even in retirement. So in this case, it does not make sense to contribute to your personal retirement accounts on a pre-tax basis because you're not really gaining much tax benefit. In fact, you may be taking a big risk because if you contribute on a pre-tax basis, which is going to save you that 12% federal tax, there's a good chance that when you retire down the road, you'll pay taxes on that money at a higher rate when you take the money out.
And why is that, guys?
Well, you know, JB, you just got to open your eyes and just look at this country, the way we're spending, the debt we have, the growing interest problem. There's a good chance that tax rates are going to be higher in the future. So in the previous example, this couple may find themselves in a higher tax bracket in retirement and basically paying taxes on money later at a higher rate than they are right now. This can be a problem with saving money in a pre-tax position. Most people do save in a pre-tax position now, but, you know, with this new tax code in place, you may very well want to take another look at the way you're doing things. Again, you may be in a position where it does not make any sense for you to do this because you really aren't getting much of a tax benefit anymore by saving on a pre-tax basis. You should be much better off paying the tax today at today's very low tax rates and then benefit later on down the line when you pull that money out later when it's taxable. Again, it's just smart planning. And again, I invite anybody to pick up the phone and call us at 336-391-3409 if you want to talk about your situation, because I know this is a big change for most of you. So again, you know, each person, you've got to look at your own individual situation and figure out the best way to save for retirement tax-wise. Now, when considering this, you have to look at more than just your current tax bracket versus your possible future tax bracket. You also have to consider other sources of income that will take you into retirement that could be taxed. For instance, Social Security. Because again, in a pre-tax contribution type plan, when you take that money out, it's taxable. And it's also, in all probability, going to cause your Social Security benefits to be taxed. But in a Roth, if you take that money out tax-free, it's not going to cause your Social Security to be taxed. So again, you have to consider other factors to really figure out the best way for you to save in retirement. You want to save the most proper way for your unique situation, and also in such a way that will give you the ultimate value, not only in the amount it grows to, but in tax benefits down the road as well.
Okay, guys, our next factor in maximizing your retirement accounts is the fee issue.
Yeah, that's right. Contributing to retirement accounts and savings plans, it's not free. Mm-hmm. Many people do not realize that even with the employer-sponsored retirement plans, there are expenses and fees. Specifically, there are plan expenses and fund fees. It costs money for companies to sponsor and run a 401k plan, and this hefty tab generally comes out of your retirement returns. The same is true for some independent and personal retirement plans like IRAs. Fortunately, there are strategies available to minimize the effects of these fees and expenses. Hey, don't get me wrong. I'm not against fees, and not all fees and expenses are bad. Paying a fair fee for professional money management to maximize returns and control your risk on your portfolio and your nest egg is a good thing, especially if you don't have the expertise and the ability to do it yourself. But in all cases, do what you can to consider these fees and minimize them, or at least make sure they're worth it for what you're getting. What is the next way to maximize our personal retirement accounts, JB?
Well, Doug, the next factor is to invest smartly.
Well, obviously you want to do this. Unfortunately, it's much easier said than done, especially with all the options and strategies that are available in today's investment world. And unfortunately, with retirement accounts especially, many people utilize that buy and hold approach and target date funds within company-sponsored plans because that is what a lot of companies are offering now as options inside those plans. Remember, with company-sponsored retirement plans, you're kind of at the mercy of the company, and they only have to offer what they want to offer. Many times they don't offer too many really valuable tools to invest the money. It's more of a buy and hold approach. These choices encourage the set it and forget it strategy, and unfortunately this strategy just does not work very well in these high volatility economic environments.
That's very true, yep.
With volatility more potent today than ever before, and with another major market correction overdue and expected at any time, the set and forget it approach is a very, very bad decision. Remember, every time you lose money in the market, you have to make a higher percentage to get it back. Simply put, losses count more than gains. Let me give you an example. If you lose 50% of your account, you've got to earn 100% to get it back. Not 50%, 100%. You have to earn double just to get back to even. So if you want to ruin your retirement plan, simply take more losses than gains in your portfolio, and you'll go down pretty quick. This happened to a lot of folks back in 08 and 09, and the loss of a lot of money, and it took more years than you can imagine just to get it back. Obviously, this is not something you want to go through. A lot of those buy and hold target fund approaches are inside those company-sponsored plans are not going to adjust and adapt, and they just basically follow the market. So you want to make sure you have a way to make adjustments when market conditions start to change so you don't take these big hits. Now, I'm sure most of you don't want to take the big hits, especially if you're close to retirement, so make sure you invest smartly. Make sure you're receiving the proper investment advice and have the right type of risk management system employed to grow and protect your money in today's volatile and ever-changing market environment. Remember, markets are at all-time highs. It's not a question of if another big correction's coming. It's just a matter of when. So you don't want to participate in that big time fall when it occurs, but you also want to take advantage of these markets while they're going up. I certainly get that. The good news is there are ways to do both. You just have to know about the investment strategies that are available in order for you to do that. So why don't you become educated on these options? And if you want additional information, I invite you to give us a call at 336-391-3409.
That's some great information, Doug. Well, guys, let's turn our attention to answering some very good retirement savings questions. The first question is regarding something you mentioned earlier. You said something about being able to contribute to multiple accounts. Can you contribute to more than one retirement savings account, such as a 401k plan and an individual retirement account?
Yeah, JB. Actually, in most cases you can, and that's despite what so many people think. You can contribute to multiple accounts as long as you stay within the IRS and plan guidelines. For instance, you may be able to contribute and max out a 401k plan at work. Again, depending on your age, that may be $24,500 per year. And at the same time, contribute to some type of personal retirement account, such as an IRA or Roth IRA. Of course, depending on how much you make and other qualification guidelines. Again, many people qualify and are able to do this, but they just don't know it. So the answer to your question, JB, is yes. You very well may be able to contribute to multiple types of accounts. And on top of that, there are other types of accounts that don't have any guidelines, which allows you to contribute much more if you want. So if you're really interested in saving as much for retirement as you possibly can, and I certainly hope you are, there's a lot of ways to do it. So please don't feel that if you maximize your retirement plan out at work that you don't have any more options. Generally, you do have those other options, and you just want to take advantage of them.
Well, let me ask you this. How about contributing for a spouse? If one spouse does not have earned income, can the working spouse contribute for a non-working spouse?
Another good question,
Yeah,
JB.
Yep.
A lot of people think that answer is no, but actually it's yes. You can contribute for a non-working spouse as long as you have enough earned income to contribute for both. So let's do an example.
Okay.
Let's say your spouse doesn't work, but you make $50,000 per year. You can contribute to a traditional IRA or a Roth IRA up to the maximum amount of $5,500 or $6,500. And you can contribute another $5,500 or $6,500 for your spouse as well. You can do this as long as you have enough income to cover these contributions. Again, you need to be aware of these things. It may be another way for you to maximize your retirement accounts and build that nest egg.
Obviously, guys, part of maximizing your retirement accounts is meeting the deadlines. What are the deadlines each year for contributing?
Well, another good question. It depends on the type of plan. For instance, a 401k and a 403b, those employee-sponsored plans have end-of-the-year deadlines. So let's say you're 55, you want to put $24,500 in for this year, 2018. You can do it, but it has to be done by December 31st. For personal accounts such as IRAs and Roths, you have until April 15th of the following year. So if I'm doing my taxes in March of 19 and for the 2018 tax year, I realize that I didn't contribute, I still have time up until April 15th of that year. All right, guys, we're pretty close to the end of the show. We had a good conversation today about these retirement accounts. I really appreciate your inputs. And folks out there, if you have any questions at all about how to do any of this or maximizing your retirement accounts, please don't hesitate to call us at 336-391-3409, or we've got a lot of good information on our website at www.thewealthguardians.com. So until next week, stay tuned, and we'll be right back here on the Wealth Guardians radio program.
The information provided is for educational purposes only and not intended as investment advice for any individual or entity. All information contained herein is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy. The views presented today are those of Wealth Guardians and do not necessarily represent the views of the Alpha Star Capital Management. The opinions expressed are subject to change without notice and do not constitute financial, legal, or tax advice. Any comments regarding safe and secure investments and guaranteed income refer only to fixed insurance products offered by Wealth Guardians. They do not refer in any way to securities or investment advisory products. Please consult your financial professional before executing any financial strategy. Investment advisory services offered through Alpha Star Capital Management, a registered investment advisor. Alpha Star and Wealth Guardians are independent entities.